We are halfway through the year, amazingly, so it's time for our mid-year update. We are going to be looking at stock market performance in the first half, interest rates, some wild moves in the precious metal space, jobs, and of course, SpaceX. We also got more. Let's dive into it. So we are halfway through the year, and it has been a good year so far for much of the stock market. When we came into this year, we were off 3 straight years of gains. It had been a very good stretch, and there were a lot of questions on, can the markets make it 4 years in a row? In our 2026 outlook, it was entitled The Case for a Good Year. We made the case of why it should do well, but you never know exactly what the market's going to throw at you. So on the screen here, you see the S&P 500's up 9.5% through mid-year, and it didn't go that way in a straight line. March was a very challenging month when you had the Iran conflict in the Middle East, led to a lot of volatility. In fact, the stock market dropped almost 10% from top to bottom in that first quarter, with most of the decline happening in March. But buyers came in late March, even before things were settled over there, and we had a tremendous rally in the S&P 500 from that point until late in the second quarter. June was a little volatile, but 9.5%, we will take it. Not only that, the Dow Jones Industrial Average up 8.7, nice to see there. This is the biggest shocker though, these next two numbers. The QQQ, which is basically the NASDAQ 100, the biggest tech names are mostly in there, was up almost 20% the first half of the year. Now, that hasn't been unusual. The last 10 years, tech has done very well. We have had a heavy overweight to tech here in our firm. But the big surprise is that the Mag 7, which are the biggest 7 companies, NVIDIA and Google are in there, Microsoft, Meta, and so forth, down 2.5%. This is a shocker. In fact, if you had told me and anyone in the financial world at the start of the year, hey, midway through the year, the Mag 7 as a group is going to be down 2.5%. What's the rest of the market going to be doing? We would have probably said negative. But this has not worked out that way. A 20% gain in the QQQ Trust. And the big reason for that is the chip sector. This was memory and storage chip makers had a field day because AI needed a lot more of those chips than what a lot of analysts thought. So you had companies like Micron and Western Digital take off and have 200, 300% gains in the first half of the year, and earnings skyrocketed, which, by the way, these companies are charging a whole lot more for their chips. If you've recently gone out in the last week, like my oldest son, to buy an Apple computer, a Mac, those prices just went up $300 a piece for their Macs as a result. So there's real life implications of these chip prices going up so much. So that group really brought the QQQ Trust, the NASDAQ 100, up so much. Now, the next item here, the Russell 2000, this is small caps, leading here, 22% gain in the first half. This is amazing because for the last 5 years, small caps have gotten obliterated by the S&P 500 and anything large cap related. In fact, coming into this year, large cap had outperformed small cap 8 of the last 9 years. But that's not the case so far. 22% for small cap, 9.5% for large cap in the S&P. That is a big winner for small cap, and that is good because typically if you go back 20 years, when small cap have started to outperform, they tend to outperform for years at a time. So that could be real good news for the future hopes of small cap continuing to do well. All right, that brings us to gold and silver, which, listen, normally we wouldn't highlight them in a mid-year, but we're doing it because if you can look on the far left in gold color and in green, which green is silver, those two were an absolute rocket ship for a lot of 2025, and then especially in January of this year. Anyone who was in that trade for over a year did very, very well. But most of the money went in to silver and gold in January, and late January at that. We had a video, we'll put up the title there, but basically we said for silver especially, this looked like a mania. It was a parabolic move. It had gone straight up, and there was so much hype and euphoria. That normally does not mean good things ahead. And lo and behold, from that time till now, silver is down 53%. It has gotten torched, which the problem is a lot of people who bought silver at that time thought that it was only going to continue going up. They have found out the hard way that is not the case. Now, let's talk a little bit about sentiment and emotion here, because as it relates to, there's two things I want to share with you. The first is on gold. Now we have the opposite is the case. There is very much negativity around it, which to us means there could be opportunity. This is a chart that looks at sentiment of gold investors, and this goes back to 2006 in green there. You can see the red dot. We are at one of the lowest level, meaning investors are very pessimistic right now. And if you look, there are 7 or 8 other occasions over the last 20 years when gold has had that level of pessimism it has right now. So the question is, when everybody is super negative, what has gold's return been looking forward? That's what this is telling us. So down near the bottom, you'll see in the green box, 1 month later, a gain of every occasion 1 month later after this level of pessimism, gold has gone up. And then on the far right side, 1 year later, 100% of the time, gold has been higher on average of gain of 16%. So listen, if you have been wanting to invest in gold for a while and somehow you didn't earlier this year when there was a lot of excitement, now is definitely a good time to take a look and see. This makes the case it could have very good performance in the year ahead. Now, the second thing about sentiment and emotion that I want to talk about is as it relates to investing portfolios and planning for clients. There is a big trend in the investment world and the financial planning world, that's what we do here. We're in Metro Atlanta, is risk-tolerant questionnaires, where basically someone gets asked how do they feel, and it gives different scenarios and letting them know, are they a bigger risk taker or are they not? The issue is that a lot of times the answers depend on how have the markets been doing recently. If you give that after a big 30-40% sell-off in the market, that person is going to answer much differently than if the market's at all-time highs. We had a client of ours that when we first met, when they were a prospect, they came in, and I'm going to give you some of the numbers because this is very fascinating. And her name was Diane. We've changed the name, of course, but at the time she was 62 years old. She said she wanted to retire at 67. She thought at the time she was going to need about $5,000 a month to live off of when she retired. And of course, that would go up each year to keep track with inflation. $1,700 a month was her Social Security estimate, and then she had an airline pension of $1,300. So that's about $3,000 a month there between those sources of income, leaving about a $2,000 shortfall. So I told Diana, I said, hey, tell me, what's the reason you're here? And she said, well, the thing is back 3-4 years ago, right before the financial crisis, she said, I had investments with a firm that when I came in, they basically just asked a couple questions. And the biggest one was, hey, are you a risk taker? Do you mind taking risk? Or are you more conservative by nature? And she said, I didn't really know how to answer that. I told them, you know what, I don't mind risk. I guess a few friends of mine think I'm more of a risk taker. She said, after that, they said, great, we've taken care of your investment portfolio. Well, here's the thing. Because of that answer, they put her in 100% stocks. So Diane went on to say she had 500,000 in late 2007 in her investment portfolios. After the big sell-off, though, she declined to $260,000. That's an almost 50% sell-off. And look below that on this slide, because this is the sad part of the story. At the 500,000 level she was at before, that would have provided at least $2,000 a month for her to safely draw out of her investment portfolio without real risk of running out of money prematurely. Now, however, $260,000 would not provide that same income, leaving her now with a $1,000 shortfall she was going to have to try to make up in the next few years. So listen, this is not the right way. Risk tolerance questionnaires and using that to determine a portfolio allocation is not the right way to do this. And here in our firm, Centera Capital, we have a full process where we do a financial plan. And for a lot of people, that means a retirement plan. We take a look at what their assets are, what future income sources are going to be, whether that's Social Security, a pension, a part-time income, and most importantly, what their spending needs are going to be. We adjust that for inflation and come up with what's the right rate of return that's going to allow the client to be able to safely retire without risk of running out money earlier, and use that to manage and put in the investment allocation. So good story, wanted to tell you, because the truth is there's a lot of people out there today whose portfolio is because of how they answered a couple questions. If that's you, reach out to us. We'd love to talk to you. All right, let's get back to the markets overview of the first half, and we're going to look back at the first quarter when we had a massive earnings, aka profits beat in the S&P 500. We talked about this a lot in the first half of the year, so we're not going to spend a lot of time on this. The main takeaway is this. On April 1st, first quarter profits were projected to grow about 13% by analysts for the S&P 500. By the time the quarter was over, or earnings season was over, 28.5% profit gains. Tech led the way, up 50%, but we also had industrials and financials, consumer discretionary, all had an amazing growth rate of 20% or higher. It was very broad, and a lot of people didn't expect that. The last piece of good news, we are now early in July. Second quarter earnings reports get started kind of mid-July, and we'll talk a lot about them later on. But right now, earnings are expected to grow at 23% year over year. It was 16% at the start of the year was expected. So we're talking about profits are really exploding, and that's been a huge driver of higher stock prices. It's one of the big reasons stocks could very well be a lot higher by the end of the year than they are today. All right, two other charts in this little segment. One is looking at oil, because that was a huge story earlier in the year. Oil was in the $57, $58 range for WTI. West Texas crude went all the way up to $115 when we had the Middle East conflict. Anyone who was driving around knows gas prices got very, very expensive. Energy costs went up for companies across the board. But of note is once we got from late May to the end of June, oil prices just plummeted, even though we didn't have official resolution in the Middle East. They're sitting right around $70, $71 a barrel right now. And this is a big deal because a lot of analysts, oil analysts, mind you, a month or 2 months ago said oil may not go back anytime soon to where they were before the conflict. They could stay in the 80s and 90s all year long. This is very good news that it is not happen that way. Now, the last chart in this segment, we're talking about interest rates. We don't want to put anybody to sleep with this, but this matters because the 10-year Treasury rate has been bouncing around for the last year and a half between 4% on the low end and 4.5 to 4.6% on the high end most of the time. A lot of analysts want to see this go to 4 and break below it because that will lower rates when corporations are trying to borrow, and also for housing, it'll bring mortgage rates down. The 30-year mortgage rate right now is 6.5%, which just is not good news for housing. Housing has had a tough year so far. We are at 4.5%, as you can see there, or right beside it, 4.48. So in the back half, it's going to be very important to watch this. Does it break higher or lower? We hope for the latter. Okay, next topic, we're looking at the jobs market. This is very important for the health of the economy. And one of the big stories last year in 2025 was that finding a job was not easy to do. And so what we have in front of you is over the last year, what the monthly jobs number was, and in blue is the 3-month moving average, because the jobs number bounces around significantly month to month, so the 3-month moving average gives us a better idea. You can see from July of 25 through February of 26, this number was in the negatives more than the positives. That was not good, made it hard to find jobs. However, starting in March, the market has taken a turn upward, and this is good news. You will see that we are now sitting at 111,000 jobs gained per average over the last 3 months. And there were a lot of people who said the new break even was 50,000. So anything above 50,000 was a real benefit. Under 50 was trouble. So this is safely above that. It isn't just monthly jobs gained that has been going in the right direction. The next chart has been very key over the last 4 years, and we're talking about initial claims for unemployment insurance, jobless claims. When someone gets laid off, if they can't immediately find a job, they go file for their benefits. And this has stayed very low in a range between around 190,000 and 260 over the last 3 or 4 years. We've watched this carefully and have said, if this starts heading northward and goes up to 300, 350,000 or higher layoffs, that is going to be bad news for the consumer and bad news for the economy. Well, you can see this has stayed low pretty much all year long. It's at 215,000 last week. That's a very low number, and tells you companies just are not doing a lot of layoffs. And why that matters is the next chart we're going to talk about is this fear over the last year that a lot of people have had for AI causing the unemployment rate to skyrocket. Well, the unemployment rate is 4.2%, about where it's been on average over the last 2 years. We're not seeing a lot of layoffs there. So far, there is no sign that AI is causing a lot of layoffs to occur. But I also want to show you this chart, which is an analysis that put companies into 2 categories: high AI adoption, meaning they're using AI a lot and encouraging their employees to, and low AI adoption. In the companies that have the high AI adoption, they have had a 10% increase in worker numbers, meaning they are bringing on more workers. Whereas the low AI adoption, no change basically. Then for entry-level workers, because that's another narrative over the last year, entry-level are going to have a hard time. What we've seen here is the high AI adopters have had a 12% increase in entry-level workers, where the low AI adoption, almost no change. So this is a big deal. We talked a little bit about some of these very topics a couple weeks back in a video. You can check that out if you want to. We're in the camp that AI is not going to cause significant job loss and a sky-high unemployment rate in the next couple of years. We think actually it's going to lead to more prosperity as it starts to get used more and more. Our final topic here is SpaceX, one of the most anticipated IPOs, initial public offerings of all time. I have never seen excitement like we saw here. And when this came public, it was at $135. It went all the way up to $225 in the first week as all the people who couldn't get shares all crowded in, and then has dropped back down to around 148, 150 recently. We said it's going to be volatile. If you buy shares, expect it and don't be surprised. Later this year, we'll get IPOs of OpenAI and Anthropic, so it's a big year. This is the update with SpaceX so far. Okay, so the key takeaways are the stock market has had a good first half of the year powered by earnings growth. We have seen oil prices come down. We have seen precious metals like gold and silver come down. And the jobs market has turned around after a tough end to 2025. Listen, if you are new to Centera Capital, you can go to our website and find out more about us. And if you're like Diane earlier in the story and you're invested based on a risk tolerance questionnaire, reach out. We'd love to talk to you. Thanks for watching and take care.